What's up, everyone? It's Caddy with Money Vesting. So I'm gonna try my best to make sure that the audio and the video is good because I am traveling right now. So I do apologize. So again, hope you guys are doing great. Make sure that you drop a like and of course subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is gonna be down below. And there is a 16% annual discount for our Discord and for Patreon until tonight. So after tonight, it is gonna expire. So if you want to take advantage of all the buy and sell alerts, options alerts, trade ideas, everything's going to be included with the link down below. Now in this video, I wanted to focus on the most important thing that we need to pay attention to over the next few weeks. And the reason why this is so important is because June 1st is here, right? And the X date is fast approaching. There's going to be a lot of things that we need to address and talk about. So there's a lot to unpack in this video that I want to go over. And there was some research and some analysis done by the actual Bipartisan Policy Center. And that's what we're going to discuss here. So the most important thing, in my opinion, right now that we need to focus on is going to be the 10-year yield. The Treasury yield right now is going to be very important. This is exactly where my focus is. I'm not watching anything else. Literally, I'm not watching what the equity markets are doing. I'm not watching what the credit spreads or the volatility or anything else. I'm simply focusing on what the 10-year yield is doing right now because of the potential for not only a resolution with the debt ceiling, but also the auctions that are going to take place in the future after the debt ceiling is raised or suspended altogether, because the US government, the Treasury Department, is going to need more capital, need more cash in order to function properly. I'm going to go over some of the very interesting analysis that was done by the Bipartisan Policy Center, and this literally just came out about a week ago. So on May 22nd, 2023, the US Treasury Secretary Janet Yellen notified Congress that the Treasury Department, the Treasury, may not be able to meet all their government obligation after June 1st, 2023, and we are here today. And that date has been increased to, I think, June 5th. I think that's 4 days, 5 days of buffer that's available. And BPC, which is the Bipartisan Policy Center, projects that if policymakers do not act on the debt limit, Treasury will most likely have insufficient cash to meet all its financial obligations sometime between early June and early August 2023. So in the next 1 month, it is going to be very important for us to pay attention to what goes on in the bond market with an elevated risk between June 2nd and June 13th. So that 9 to 12 day period is also going to be very important because they call this the X date. And the X date is really when the Treasury Department completely runs out of all cash. The balance is close to zero, and they're going to have to finance all the expenditures with the income that's coming in, which is the cash flow coming in through tax revenue. So on May 4th, 2023, Treasury sold $50 billion of 4-week securities scheduled to mature on June 6th at a record 5.84%. By the way, that yield jumped to over 7% because of the elevated risk related to the US defaulting on its debt. US credit default swaps spreads have also increased. So again, CDS products have also increased, the highest level we've ever seen. And in the absence of a bipartisan legislative agreement, Treasury would be forced to choose among unprecedented unilateral actions. There's a couple of scenarios that they also talked about, but very quickly, the X date is the first day on which Treasury has exhausted its borrowing authority and no longer has sufficient funds via extraordinary measures, residual cash on hand, or daily revenues to meet all its obligations in full and on time. So what does that mean? This right here is a calendar of June 2023. We are on Thursday, June 1st. This is where we are today. So if you're watching this video, of course, it's going to be, 11:30 or close to midnight in the US when I post this video. So it's going to be Thursday, June 1st. These are the expenses for $47 billion Medicare expense, $12 billion military and civil retirement, and $12 billion in veteran benefits. When you combine that, it's closer to $60, $75 billion worth of expenses the Treasury needs to have for just today. That's Thursday, June 1st. And then on Friday, we got Social Security, we got Medicaid, and this is the entire calendar. So you can pause this video, you can check that out for yourself. But every single day, the US is needing close to $75 to $100 billion of cash that they need to spend. This right here is going to be the July calendar. Again, Social Security, civil retirement, we got Medicare, housing programs, educational programs, defensive vendors, all of that are going to be expenses for the Treasury. So this right here is going to be just 1 day cash flow that I'm looking at, right? Thursday, June 1st, 2023. Daily outflow is going to be closer to $101 billion, and inflows, which is through tax revenues, $21 billion, right? So there's a big discrepancy there. Usually this deficit right here is financed through debt, but because the Treasury is running very, very low on cash and they're not allowed to borrow just yet, this obviously is going to create even more deficit, which obviously is going to increase the likelihood of a potential default and of course increase the risk related to a default as well. This right here is going to be Friday, June 2nd, so not Thursday, but the day after. Again, $40 billion in spending and $13 billion in revenue. This right here is going to be Monday, so the following Monday on June 5th, which is supposedly the X date. $13 billion in spending and $21 billion of revenue. So we do have a little bit of surplus there, but that's obviously going to be used up in the following days fairly quickly because the spending is still very much higher than the actual inflows or the cash. Now, during the 2017 debt limit episode, market uncertainty increased interest rates on some Treasury bills maturing near the October X date range. So again, it's very likely that we do see a little bit of an increase once again in the bond market. That's exactly why I'm paying attention to the 10-year, the 20-year, the 30-year. And I've taken a very small position on TLT TMF. I plan to size up eventually, right? Once all this is, when the dust settles, basically when we are kind of through this entire process. But this right here is going to be the U.S. credit default swaps. The CDS continue to rise, now exceeding levels seen during the 2011 debt episode. And this right here is a calendar of debt maturing for the U.S. as well. And these are obligations that the U.S. government has to basically pay, right? $105 billion June 1st, $136 billion on June 6th, June 8th, $102 billion. This is all the debt that they've already issued that's maturing, so they have to pay the principal back. If they don't pay, then the risk is elevated, yields will skyrocket to the upside, and that's, we also know there's a short, massive short position on the Treasury market right now, biggest we've ever seen in 23 years. So the risks are real. Treasury market and market risk beyond the X date, Treasury market interest rates, that's the primary risk right there. If the yields start to increase, the interest on the debt increase, thereby increasing the debt that they have to pay on the actual or the interest that they have to pay on the debt itself, which obviously is going to create even more deficits, and that's going to create even much bigger problem. And of course, equity markets, including 401ks, IRAs, and other positions, U.S. economy, including missed payments to businesses and individuals in the global financial system as well. Now, this right here is the auction market right now from Treasury Direct specific website. We don't have any schedules for notes or bonds, which are long duration assets. We do have 4-week, 8-week, 13-week, 26-week, and 3-day auctions. This right here, May 31st, but we have nothing scheduled yet. And this is where the real concern comes in and the uncertainty comes in, because we don't know if the demand's going to be there once the dust settles and the resolution happens. Of course, it's going to be there because we haven't really had any proper auctions in some time, because there's been some conversations around the debt ceiling, of course, for the fact that right now it's kind of hitting that limit. So if we have those auctions, the demand level for the auction is really what's going to determine where the 10-year yield goes, right? So if the demand's high, we could see the 10-year yield drop and bond prices increase. If the demand is low and there's a lot of supply and there's elevated risk, yields could rise. Or if the demand kind of meets that supply once the auctions begin, then it's possible the yield doesn't move much and we don't really see a significant amounts of volatility. So this is where my focus is. This is exactly what I'm paying attention to right now in the markets. I'm not looking at anything else except for the 10-year yields. But let me know in the comment section below, what do you think? I personally believe that the next few weeks are going to be very important for the market. I'm still going to size up if there is an increase in the 10-year yields, 20-year or 30-year. Right now, we're seeing a little bit of an increase, about 0.5%. And we also know there's a massive short position against the bond prices, or the bonds really, and they're expecting yields to rise once again. So my focus is going to be on this, and I'll be trading TLT or TMF off of the 10-year treasuries or 20-year treasuries. And eventually when the dust settles, I do expect the yields to drop off pretty aggressively and for bond prices to start increasing once again. So that's going to be the playbook, but this is what I'm watching for now. Just want to keep you guys updated. As always, make sure that you drop a like and of course subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.